Welcome to Have You Read It, the channel where we bring books to life, one summary at a time. Today, we're diving deep into John C. Bogle's Common Sense on Mutual Funds, a book that's as relevant today as it was when it was first published. This isn't just a book about mutual funds, it's a philosophy on investing, a critique of the industry, and a compelling case for simplicity. We're going to unpack it all, so grab your favorite beverage and settle in. This is going to be a deep dive. Bogle, the founder of Vanguard, begins by establishing a core principle: long-term investing. He argues that while short-term market fluctuations are unpredictable, long-term trends are more reliable. He uses historical data, going all the way back to 1802 in some cases, to illustrate the consistent, albeit volatile, returns of stocks and bonds over time. Stocks, he shows, have historically outperformed bonds in the long run, but with greater volatility. This sets the stage for his emphasis on a balanced approach, incorporating both asset classes. Siegel's Stocks for the Long Run is a key source for much of this historical data. A crucial element in Bogle's analysis is the concept of real returns, adjusted for inflation. He stresses that the true measure of investment success isn't the nominal gain, but the increase in purchasing power. This point is repeatedly underscored throughout the book, highlighting the importance of understanding inflation's impact on long-term investment goals. He introduces Occam's razor, the principle that the simplest explanation is usually the best, to simplify the often complex world of investment returns. For stocks, he simplifies the factors to dividend yield, earnings growth, and changes in the price-earnings ratio. For bonds, the dominant factor is the initial interest rate. This approach helps illustrate that while speculation plays a role in short-term market movements, long-term returns are primarily driven by underlying economic fundamentals. Bogle doesn't shy away from tackling the elephant in the room: investment costs. He uses the pie theory to illustrate that, while actively managed funds try to outperform the market, all investors collectively earn the market's return before fees. Actively managed funds, with their higher fees and transaction costs, inevitably reduce the investor's share of that pie, leaving passive investors like index fund holders with a larger slice. This is a powerful and repeatedly emphasized argument in the book. Next, he discusses asset allocation, calling it the most important investment decision. He suggests a starting point of a 2/3 stock, 1/3 bond portfolio, but emphasizes that this should be tailored to individual circumstances, risk tolerance, time horizon, and financial situation. He introduces a 4-quadrant matrix to guide investors in determining their appropriate stock-bond mix based on age and investment stage, accumulation versus distribution. He also discusses the strategies of fixed ratio allocation and benign neglect. While he acknowledges tactical asset allocation, he cautions against overly aggressive strategies. A significant portion of the book is dedicated to indexing. Bogle champions index funds that simply track a market index like the S&P 500, as the simplest and most effective investment strategy for the average investor. He cites the historical outperformance of index funds over actively managed funds, attributing this success largely to lower costs. He emphasizes that while the S&P 500 is a widely used benchmark, the entire market, as represented by the Wilshire 5000, is a more comprehensive measure. He cautions readers about the variety of index funds available, stressing the importance of selecting low-cost, tax-efficient options that align with the investor's goals. Bogle then analyzes different equity styles: large cap, small cap, growth, value, and blends. He finds that while returns across styles tend to be similar over the long term, risk varies significantly. He highlights the importance of considering risk-adjusted returns rather than just raw returns, emphasizing that funds with higher expenses often assume more risk without commensurate gains. He cleverly uses a tic-tac-toe analogy to illustrate that the quest for consistently outperforming fund managers is likely a futile one. The analysis extends to bond funds, where he finds a similar pattern: high costs often lead to lower returns. He argues that the inherent simplicity of many bond instruments makes it difficult for active managers to consistently outperform, making low-cost index funds a compelling choice. He criticizes the prevalence of sales loads on bond funds, considering it particularly unreasonable given the generally lower returns of bonds compared to stocks. Bogle also explores global investing. While acknowledging the benefits of diversification, he advocates a cautious approach, recommending a maximum of 20% of a portfolio allocated to international stocks. He challenges the idea of a fully market-weighted global portfolio, citing the inherent currency risk and the uncertainties of predicting the relative performance of international markets. He reinforces the acres of diamonds philosophy, suggesting that focusing on the U.S. market is often a more sensible approach given its strength and familiarity. The book turns to the challenging task of selecting superior funds. Bogle reviews multiple academic studies that fail to find consistent evidence that past performance predicts future success. He examines the records of top-performing funds, finding that their performance often regresses toward the mean over time. He also analyzes the performance of professional fund selection services and funds of funds, finding that these, too, largely fail to consistently outperform market indexes. He uses the analogy of Pascal's wager to illustrate the risks of betting on active management when the odds of success are low. Bogle then addresses the phenomenon of investment relativism, where the focus shifts from absolute long-term returns to short-term performance relative to a benchmark, often the S&P 500. He argues that this short-term focus leads to closet indexing, where managers mimic the index, sacrificing potential outperformance. He criticizes the lack of transparency in this practice, as well as the tendency for managers to focus on quarterly performance reports over long-term value creation. The impact of asset size on fund performance is a central theme. Bogle argues that large fund size can limit investment flexibility, increase transaction costs, and hinder the ability of individual managers to add value. He demonstrates this using data on the performance of some of the largest actively managed funds, showing a decline in relative performance as their assets increased. He cites Warren Buffett's views on asset size as being detrimental to investment performance. He also details how the effective size of a fund often exceeds its stated asset value when considering related funds and institutional accounts managed by the same organization. Bogle gives significant attention to taxes, arguing that they represent a substantial hidden cost of investing, often ignored by fund managers and investors alike. He shows that high fund turnover leads to greater tax liabilities for investors, especially those with taxable accounts. He contrasts the tax efficiency of index funds, due to their low turnover, with the tax inefficiency of actively managed funds. He makes a strong case for the value of tax deferral. He suggests solutions, including the creation of tax-managed funds that emphasize minimizing capital gains distributions. The final element he examines is time. He uses a four-dimensional model, reward, risk, cost, and time, to show their interplay. He emphasizes that time magnifies the effects of compounding, both positively for returns and negatively for costs. The longer an investor's time horizon, the greater the benefits of compounding returns, and the greater the penalty of compounding costs. He also shows how the volatility of stock returns decreases dramatically over longer time horizons. The book's second half shifts to a critique of the mutual fund industry's structure and practices. Bogle argues that the industry has become overly focused on distribution and marketing at the expense of prudent investment management. He criticizes the prevalence of 12b1 fees, which are used to pay for marketing expenses, arguing that these fees don't benefit investors. He also discusses the detrimental effects of aggressive marketing campaigns that hype past performance and create unrealistic expectations. He contrasts this with the true fiduciary responsibility of a fund manager. He then examines the role of technology in the industry, While acknowledging the benefits of faster transactions and greater access to information, he warns against the risks of excessive trading and the treating of mutual funds as short-term speculative vehicles. He notes that the ease of trading funds online can lead to impulsive decisions that negatively impact returns. Bogle addresses the issue of mutual fund directors, arguing that many do not act independently in the best interests of shareholders. He highlights conflicts of interest, particularly the close ties between fund directors and the management companies. He cites excessive director fees and the low level of fund ownership by independent directors as evidence of this lack of independence. He proposes alternative governance structures to better align the interests of directors and shareholders. The final chapters focus on Vanguard's unique structure and philosophy. He describes his entrepreneurial journey in founding Vanguard, including the challenges and successes he faced. He details Vanguard's internal management structure, contrasting it with the conventional external management model. He emphasizes the importance of simplicity, cost control, and long-term investing in his leadership philosophy. He discusses the importance of treating both clients and employees with respect and dignity. He highlights Vanguard's partnership plan, which rewards employees based on value added to shareholder returns, aligning employee and shareholder interests. He uses this as an example of how a focus on human beings can lead to a successful and ethical business. Bogle concludes by emphasizing that the mutual fund industry must prioritize shareholder interests, advocating for a shift in focus from marketing to management and from short-term gain to long-term value creation. He calls for increased transparency and accountability, particularly regarding fees and investment strategies. He hopes for a renewed focus on the founding principles of the industry: prudent management, diversification, and service. So, what's the main takeaway from Common Sense on Mutual Funds? It's simple: invest intelligently, simply, and for the long term. Bogle emphasizes the importance of minimizing costs, diversifying your investments, and understanding that past performance is not indicative of future results. He champions passive investing through index funds as a particularly effective way to achieve these goals. Here are some key heuristics to remember. Keep costs low. Minimize fees and expenses, as they significantly impact long-term returns. Diversify wisely. Don't put all your eggs in one basket. A balanced portfolio of stocks and bonds is a good starting point. Index your core. Consider using low-cost index funds as the foundation of your portfolio. Don't chase performance. Past performance is not a reliable predictor of future results. Stay the course. Avoid emotional decision-making, and stick to your long-term plan, adjusting only to account for major life events. Time is your friend. The power of compounding works best over long time horizons. Thanks for watching. Make sure to give this video a thumbs up and hit that subscribe button so you never miss our next book dive.